Hello and welcome. I'm Blair Blackwell, and this is the Daily Market Brief. Let's catch up on what's moving in markets today.
Good morning, it's Friday, February 6th, and this is your New York Open Prep. The big themes: oil is easing as diplomacy chips away at the risk premium, even while shipping tensions linger, and markets are trying to stabilize after a bruising week for metals and tech, with currencies mixed and sterling under pressure. Oil first. WTI is wrapping a volatile week softer, as reports of U.S.-Iran talks drained some of the geopolitical premium. Those talks in Oman are over for now, with both sides signaling they could reconvene, but Tehran underscored its leverage by seizing 2 foreign crude tankers near Farsi Island. Meanwhile, trade flows are shifting. Tankers carrying millions of barrels of crude are hovering off East Asia as Russia redirects barrels toward China, while India pulls back, and India's Russian crude intake fell sharply in December. On the corporate side, Chevron remains in the hunt for Lukoil's international assets despite a preliminary, non-exclusive deal with Carlyle, and a separate Chevron memorandum in Syria is purely exploratory, with no impact on output. For traders, that means a thinner risk premium for now, but headline risk remains high. Turning to broader markets, Europe saw a tentative recovery. Precious metals bounced after heavy selling, with silver still in a fragile spot, according to OCBC, while gold's move was less dramatic. Crypto also steadied after a rough stretch, and U.S. equity futures are trying to claw back losses, though Amazon is under pressure after its ambitious artificial intelligence spending plan rattled investors. The AI capex wave remains a subplot, with Brown Brothers Harriman noting it could buoy commodities, particularly metals, and Goldman Sachs is leaning into it, tapping Anthropic's model to automate accounting and onboarding tasks. In currencies, the dollar is steadier to slightly softer against commodity-sensitive peers as risk tone improves. The euro is hovering near recent lows ahead of U.S. consumer sentiment later today, while the pound is heavier as markets lean toward a more dovish Bank of England path, even as Hugh Pill cautions against reading too much into an upcoming inflation dip. The yen remains weak, with dollar-yen consolidating around 157. TD Securities expects political stability after Japan's election and warns intervention risk grows if the pair pushes above 160. North of the border, Canada's January jobs report was a mixed bag. A negative headline print and a drop in participation pulled the unemployment rate lower. The move helped stabilize recent selling in dollar Canada, but broader cross-asset volatility is still doing most of the talking. Market tone: a softer oil backdrop is modestly supportive for risk, and a slight headwind for the dollar, while a metals bounce is helping the Aussie and broader commodity complex. Gulf headlines can quickly reprice crude. Looking ahead, keep an eye on U.S. consumer sentiment, any fresh signals from U.S.-Iran diplomacy, Japan election chatter, and any updates on the Supreme Court tariff bond case that could affect trade-sensitive names. What to watch today? WTI crude for a tentative downtrend as diplomacy trims the premium, but stay alert for reversals on Gulf headlines. The pound against the dollar for a downside bias as markets price a softer Bank of England path. Dollar-yen for an uptrend toward intervention-sensitive levels if U.S. data holds up and Japan stabilizes politically. The Aussie against the dollar for an uptrend on commodity strength and an improved risk tone, and silver and gold for two-way volatility tied to dollar moves. Bottom line, sentiment is stabilizing, but it's headline-driven, cautiously constructive, yet still fragile.
That's it for today's edition of the Daily Market Brief. Thanks for listening. I'm Blair Blackwell. This podcast is for informational purposes only and does not constitute financial advice, trading recommendations, or investment guidance.